Hello everybody, it's me the Boss Hog, and today we're going to look at my portfolio as of the week ending the 25th of February, my buys, sells and dividends, and oh my goodness, what a week it was. Let's do it. Alright, so, a pretty incredible week. It's my worst week ever. Worth calling out here in my table, my Russian holdings. Obviously, these got hammered on Thursday. Everest has been under some pressure for some time, as I've touched on before. Divesting its business, got oligarchs that are very friendly with Putin. It was already under significant pressure. And then that happened, so it fell further. But also on top of that, what was meant to be a kind of gold and silver hedge didn't really work as a hedge because it went down, like 40% in one day, which did most of the damage, or a significant chunk of that damage there on Thursday. And it's kind of funny, if that's quite the right word, because Thursday was my anniversary, so I booked it off work, and in the morning when my wife was still sleeping, I was like, let's just check on the portfolio. And I logged in, and it was down something like 8,000, right? Just the UK holdings. So I suppose in a way it could have been even worse. The Americans came to the rescue a little bit on Thursday, and some of my tech holdings actually delivered. So pretty wild week, honestly. It was a challenging week until then. National Express, my largest holding, continues to be under pressure. I'm not entirely sure why. It's acquiring Stagecoach, and the Mergers and Monopoly Commission wants to look at it. But that's been the case for over a month now. Also, it could be because of concern about the rising price of oil, but I think if that is the case, then it's potentially a buying opportunity because National Express hedges their oil years in advance, literally. So although they will eventually be impacted by this, they're a very conservatively run business, and it's getting to the point where it's not too far above my current average, and I think there's significant upside. So just something to put on everyone's radar there. Gamma, I continue to think, I don't even really understand why it continues to fall. I think it's a solid business. Obviously, all these figures are impacted by sentiment. And believe it or not, I've just picked, like a kind of top 10 here. So there were ones that were kind of close, but everything was moving all over the place this week. So it was difficult to know what to pick. Genius has had another good week. This is, I think, my fourth largest holding at this point. So plus 5% is fairly significant. But that was definitely a contributor on Thursday, actually. Hollywood Bowl here, again, no idea why this fell. I think it's actually significantly undervalued, as we'll get to in just a second, because it's a notable buy this week for me, so I don't want to talk about it too much now. Phoenix actually likewise as well, so I'll gloss over that for now. Salesforce had a pretty solid week. It's fallen quite a lot. I could have averaged down, but I decided not to, but I think if anyone picked up shares under 200, he got a great deal. And then Fevertree as well. I also was doing some buying on this, so again, I'll gloss over this because I've spoken about Fevertree plenty beforehand. So fine, I'm not going to talk about it further. I did add a little bit of capital. This was about the figure that I was expecting, so yeah, fine about that level. Really heavy trading week. I would say normally I feel like I have at least defensible and often actually profitable trading. I've timed some stuff quite well. Of course, you don't always get it right, but I feel like 2/3 of the time I get it good. This week I actually didn't. Mistimed some things that if I'd have waited an extra day or done things a day earlier, would have been better for me. Saying that, I did have some good moves, but it's just a case of the good moves were slightly not so good when compared to the negative moves, so kind of didn't really even each other out. And if I'm honest with myself, and I think it's important if you're trading to be honest with yourself, it was a negative trading week. I lost like a couple £100 this week in terms of the trading, so that's a little bit disappointing. Not super disappointing because I still think I was trading into shares that have lots of upside, so it's moderate, but certainly the immediate feels like a loss. Basically, I just didn't time things as well as I hoped I would, and I think it's important to own that. So here's what it is this week, and no dividends received, but that's not a surprise for me. I've actually had a decent number of dividends this month, so I'm not sad about that at all. Anyway, let's have a look at my buys because there's a couple of four figures buys this week. All right, so I haven't highlighted Amcor Green. That's mainly because I've spoken about it last week a lot. I mean, I literally was the title of my video last week, right? But basically, I continue to buy because this is now a profitable semiconductor play at a P of about 8.5 when I was buying these shares. 8.46, I think I worked out as. Can't believe it's going under the radar, and it fits bang on with my aims. So I've been buying it. And I think actually when you see what I sold, which is a company many people will admire and I've spoken about beforehand, I think you'll be a bit shocked. So I'll leave that. I'll leave that for the sales side. And again, I feel like I've spoken about Amcor before. So moving on to Hollywood Bowl. Now this is an interesting one because I did have 3,000 shares not so long ago. Sold 1,000 at like 272, 273, just because it was approaching my fair value, which is about 280. But then it's fallen since then basically. So I had 2,000 shares, but I decided to add another 1,000, and this is on top of 500 that I'd previously brought at very similar price points. So now I've actually got 3,500 Hollywood Bowl shares, so the largest holding I've ever had. I just think, again, it's going under the radar. It is a small cap for sure. Its market cap is only about 400 million. And if you just look in isolation at the earnings for the last 2 years, it looks pretty poor because, they're struggling to make a profit. But they do make a profit in both years, which, considering, they were closed for half of those years, is pretty impressive. This year, kind of looking, I might do a separate video on this, but basically as a combination of new sites opening plus increases in average spend because of some cool things they've been doing. Basically means that I'm projecting here earnings probably around 29 million. I am slightly above consensus, which is closer to 27, but I feel like actually I understand the kind of variance analysis here in terms of like units, sites, and cost basically, or sales in this case. So even if I'm out by 1 or 2 million, it doesn't fundamentally alter the theory here. That I think this is a really well-run business that's basically used the last couple of years to sort out some stuff, modernize its alleys, get preferential rates on their rents, and things like that. And now they basically have actually quite a digitally focused business that secures a lot of its revenue online now. And like they've got sort of arcades and dining and other such things. And again, I'm really happy to be buying these shares at 230. And we'll get to see. I mean, they don't publish full year results until September. But I'm expecting this to be a real winner for me. And like I say, I think 280 is a really comfortable target price for this company. And I'm also hoping actually that, assuming that the profit is north of about 25 million, that we'll be looking at a dividend this year, re-established. In the past, they had a 50% payout ratio. That was their, basically whatever they made profit, 50% of it went to shareholders. Extrapolating from that, we should be looking at a yield north of 5% at current buy prices as well. So again, this just feels really great for me, assuming that does come to pass, which I know I made a lot of assumptions there, but that's my basis here. Next up is PHNX. I've said here I could have timed it better, and that's definitely true. Because this was a fairly chunky trade, it kind of was one of the reasons why my trades were negative this week, I would say. Really, the reason is because you'll see what I sold, which basically stayed stable, but then PHNX kind of dropped another 7% after I bought these shares, so it was really frustrating for me. PHNX is a FTSE 100 company, but hardly anyone's heard of it because it's basically a niche insurance play. And it's been under a little bit of pressure because where it's been acquiring businesses, it's ended up with, third parties having fairly large stakes in PHNX, which they've then sold down. So, first of all, it was Swiss Re, and they sold, their whole stake, which was about 15%. They've now fully exited. And now basically Aberdeen is doing something very similar. PHNX Life purchased Standard Life from Aberdeen, but as a result of that, because some of it was done in shares, Aberdeen ended up with, again, about 15% of PHNX, and Aberdeen have started to sell down their stake as well. So this all has to wash through effectively, and I think until it does, there's going to be some pressure on the share price here. But again, it's a company that's about to start throwing off real cash. Because of the nature of what it does, it does actually have a surprisingly good moat. Specifically, the life assurance part typically has very small margins, but PHNX has got to the stage where basically it's able to aggregate such a large number of these policies that it's quite profitable. So no one else can compete as well as PHNX can. So it almost makes sense for you just to sell your book to PHNX, which is great. Also, as well, the government announced this week that it was looking to change what were EU rules for solvency. So basically how much money insurers have to keep on their books to cover their liabilities. For companies like PHNX that specialize in long-term life assurance policies, this is especially good. But in fairness, PHNX, Aviva, Legal & General all came out hugely supportive of this for very obvious reasons. Because what it will mean is basically these insurers in the UK are about to become more efficient on their return on assets, effectively. So again, I expect PHNX to be a winner here, and indeed UK insurers who I've spoken about beforehand as a real benefit if you want to come and invest in the UK and you're not British. I think insurance is a really great thing for you to look at, and the three companies I've mentioned there are a good start. So yeah, maybe not the best timing, but 644 doesn't feel bad for me at all. I think it's going to be a very chunky dividend. At these kind of levels, you're looking at a 45p a year dividend. So what's that, about 7%, something like that. So even that doesn't feel good. Doesn't feel bad, sorry. And I'm expecting this to have a solid 10% plus upside. Barenberg, the bank, came out with a target price of over 800p, £8. So again, there's some. I think this has a decent amount of upside for a financial. So there we go. DLR and MPW, so two REITs, one data center, one healthcare. I have been in these companies before, but sold out when I largely exited my REIT positions previously, about a year ago, really. I just felt like both of them were good value, honestly. MPW had an FFO of under 16. I think DLR was something like 20. And I bought both of them really almost perfectly. DLR especially, I don't think I could have timed it any better. MPW, I was buying, just under 20. So my average on both of these is really good, and very happy. And to be honest with you, the way I want to view REITs in the future is to kind of use them as my defensiveness. Like I enjoyed REITs when I first started because they were simple and defensive, and fine, I understood them. And then I decided I wanted other things, and I had polymetal because of this like gold and silver hedge. I know silver is a little bit different to gold. I've now educated myself on that aspect, but it still felt like a reasonable hedge. Obviously, because the miner is primarily in Russia, it didn't really work as a hedge. So need to revisit that as a strategy. Hindsight is a wonderful thing, of course, and we'll see how these things eventually shake out. Until then, I'm really happy to be building my REIT exposure, and I'm basically diversifying into my REITs as well, right? I've got these two plus O plus Vicky, and I also have been buying, although I don't currently have stake in Macerich as well, who are my shopping mall of choice, but I have currently sold out of those. And last year, I want to just talk about T. Rowe Price. I guess here I want to talk about it because I'm really pleased with the discipline of how I was buying these shares. I basically bought 10 shares each time it went under a $5 increment. So I started buying just above 150, then just above 150, then underneath 145, and then underneath 140. So I picked up these 12 shares at 139. And I just think it's like, it's massively fallen. I get the kind of it's exposed to the wider sentiment and everything else here, but it's way down in its own like averages. And I think, again, it's like a 3.5% plus yield, solid, everything. So again, this maybe isn't as exciting as maybe something like Goldman Sachs, and you'll see here actually further down I've got Huntington Bank shares as well. I wish I picked up more because I got this under 14.50, so that felt really good, but a small stake, so I'm not going to spend too much time talking about it. But T. Rowe here, very happy with this, and again, it's now green as well, so the American stock market has done quite well the last couple of days, so I've been on that as well. So yeah. Like I say, I'm actually happy with my buys. Obviously, some of them I could have timed better, but I feel like I have now quite a good core that I'm happy with in terms of my portfolio. And I've just been like basically doubling down on my bets. Some of them have gone good, like T. Rowe and Hollywood Bowl. I have made quite a lot of money on Hollywood Bowl just because I traded a chunk of it previously. But still, I expect these like Hollywood Bowl, Phoenix, to come good, and actually even Amcor now, like that's comfortably green, and because I have such a large holding in Amcor, I think I'm up to like I don't even remember, many hundreds, about £9,000 worth. But again, this is now pretty green, so that also feels really great as well. So anyway, not too much buys compared to last week, but still some notable ones for sure. Anyways, let's have a look at the sells. Not too many to cover. All right, so first up, BMY. I decided to take profit here. It was mainly because I just wanted money. It was one of the few things in my portfolio that was still green. I still think there is a decent amount of upside to BMY. I'm not really a healthcare expert, but everything I've read, and I did actually skim through their big like 100-page investor document they had. Obviously, the back end of it was like medical, but the front end of it was pipelines and stuff, which kind of can understand from a numbers perspective. But yeah, I decided to profit take and basically redeployed it into the companies I mentioned there. So T. Rowe, Bowl, and Google as well. I was very happy to be buying Google and this week as well. I guess I'm okay with this as a move. I think it will be basically cost neutral. And I think that's basically it. I wanted to get into the areas that I bought into, American bank, effectively. Big tech, I still haven't got a huge big tech chunk, right? I've got Amcor and Genius, but neither of them are big tech. So my big techs like, my Microsoft, Google, Amazon is still only a couple of percent of my portfolio. So again, I'm very keen to be buying that as well. So I decided to sell BNY. I think it's okay. If there's any opportunity to buy it again under 60 especially, or even under 65 actually, I think it's perfectly okay to buy it. I sold this just over $68, and then apparently that works out at £50. So I'm fine with it. On balance, quite a neutral move, but it aligned with what I wanted to do. This one was the one I was talking about that might be a little bit controversial. So I actually sold Disney under 150. I've been buying Disney under 150 because I expect them to have a $6 EPS this year. Obviously in their first quarter they're running behind that curve, but I think I'm expecting it to pick up. However, I think Amcor is unbelievably underpriced. So I decide, whereas Disney's probably got like 20% upside, something like that, I feel like Amcor might have something like 70-80% upside. I just think it's crazy undervalued. I was on their earnings call. I really like their CEO, even though he sounds like like a vampire. He's like, yes, I am the CEO. So he's a Dutch guy, but the way he sounds, it's quite difficult to describe. But that was good fun. But anyway, I love what they're doing there, so I decided to back that horse basically, and bought some more Amcor and sold Disney. So don't hate me too much. Legal in general, this is the flip side of buying Phoenix. So again, by the way, I sold Legal in general like 281, something like that, and or 280 maybe. Oh, it's literally there. So yeah, 280 and a half, so bang in the middle. That's okay. I actually think there's probably about 10% upside to Legal in general, and you also get a chunky yield. So it's not like I'm expecting this to be particularly cost accretive or anything like that. And as I've already touched on, I didn't time this particularly well because LGen stayed around that point and Phoenix went down another 40p. So fine. So that was unfortunate, but yeah, I like Phoenix, and I decided to again profit take on Legal in general. I made a modest profit on them with some dividends. It worked out about 7%, so nothing major here, but that's okay because I like Phoenix. And oh yeah, and by the way, so I bought 300 Phoenix shares to give me around 1,000, and put the rest into Cerillium, which is a telco billing system effectively, which is my day job, and I like the software. And actually I like the company. It is a good little number as well, small UK profitable tech company. I have to put this in here because I just mentioned about Google. But basically, so the way I manage my portfolio is in Google Docs, and I basically download from a couple of accounts I have with Trading 212, put them in there, and this does show in that download, so hence why it makes it onto here. And basically, when I was selling Bristol Myers and buying other things, I blame the tool in a way, but I was obviously just getting a bit excited with the buy and sell. So I tried to buy more shares than I had money for, and basically they force sold some of my Google shares. So that was a bit weird. It was a bit strange. I can't really explain it. But that's why it's on here basically, and then I got the money literally back 103 into my account, but it looks like a sale in the transactions, so hence why it's a sale on here. So this is a bit weird, and I never really held these shares, and this week especially I rounded up my Google holdings, so I now have exactly one Google share. I had been like dripping money into it for I don't know many weeks now actually. But this week I rounded up to have one share, so that feels nice as well. So yeah, a bit weird. So honestly, all of these companies I think are perfectly good investments. Like I don't think it's a bad decision to be buying these companies at these price points. Right? I'm pretty sure you'll make money on them. I just felt like I could do better elsewhere. Arguably that's on the margins with BNY, because I think the kind of upside is similar. Maybe Bowl is closer to 30% upside, but it's not a huge difference. It probably is close to 20%, honestly. And Google likewise feels about 20% upside. So I think the BNY move was basically fairly even. I do think Amcor is really undervalued, and again, I think it's slightly safer. Even though it's a much smaller company and arguably won't scale as well as Disney, there's a lot of upside there. And again, I really wanted to get into like smallish but profitable tech companies. Here it is. So yeah, and likewise Legal in general I think maybe is broadly equal as well. So like I said, I don't think these are going to make me lots of money, but I just they tick boxes for me for one reason or another, so I decided to action them. But I think it's totally fine buying these, and if you think I'm mad for selling Disney under 150, that's perfectly fine as well. I'll gladly take my lumps. Anyway, so a pretty wild week. I do feel a little bit beaten up, but Again, I'm kind of somewhat stoic. Since about last week, I've really become stoic and basically just rolling with the punches at the moment, trying to navigate as best as I can. So I guess that's everything. Thank you very much for watching, guys. I've been the Boss Hog, and good luck with your investing. Bye for now.